In today's In the Loop, I want to talk about the proposed $3 million super rule that everybody is talking about out there. So with me today, I have Megan Kelly from our super accounting and financial planning team. Megan, let's dive straight into it. What actually is this $3 million rule that everyone's talking about?
Yeah, so the $3 million rule that has been proposed, or the Division 296, you might have heard it referred to as well, is a new tax that the government's been trying to get through for the last few years. What the idea is that you're going to pay an extra 15% tax on the earnings of your superannuation if your account goes above that $3 million.
So if your member balance goes over $3 million, and correct me if I'm wrong, but that's where the whole unrealized gain stuff comes into it, does it?
Yes, so it's your personalised member balance if it goes over that $3 million. So as you probably realise, everyone's superannuation is tracked at market value. So when you're looking at your member balances, they are already factoring in the unrealised gains. So this $3 million will actually tax you on unrealised gains, which is something that we don't do anywhere else in our tax system. And is obviously why people are so concerned about it.
And so who's it going to impact? Obviously somebody that has a member balance of $3 million or more. Is it as simple as that?
Yeah, well, it is as simple as that. And I mean, there's a few complications in the legislation, and to be honest, they have to reintroduce this legislation into Parliament. However, it is looking very likely that it will go through this time, even though it hasn't been successful in the past. So it will impact you if your balance is already over the $3 million. But I think what you need to just realise and keep calm about is just understanding how much it will impact you. Yeah. It's not a tax on everything you've got above $3 million. Yeah. It's a tax on your growth from one year to the next. So if your fund is well over $3 million already, it's not like they're going to go back and look at the gains in the past. They're only looking forward. So it's only how much your member accounts move from one year to the next. So it is actually just an incremental tax.
Okay.
And the way they make it work is it's actually a tax not levied at a super fund level, it's levied to the individual. So for anyone who's unlucky enough out there to be paying what we call Division 293, you'd be quite familiar with this extra type of taxing, where it's a tax that relates to your super, but you get assessed and an extra assessment on your individual tax account. And then you get the option as to whether you pay it personally or you pay it out of your super fund account.
Okay, so just to recap, it's $3 million per person.
Yes.
And it's an extra 15% tax on the movement in your member balance, which includes any movement in unrealised gains and so forth.
Yes, from one year to the next.
Okay, so if you're in that situation, is there anything people should be doing maybe now before 30 June 25?
Look, what I'd say to people, and what I have been saying for the last couple of years since they first started talking about it, is please don't panic. Don't rush out and take your money out of superannuation, because when we've done the calculations, for some people this tax is going to be quite minimal considering the overall size of their benefits. So it's going to be also very different on a case-by-case basis, because it really depends on what makes up your superannuation account. It also factors in what withdrawals you're making from one year to the next as well. And we really have until 30 June 2026 before anyone is actually going to even be assessed on this tax. And then the first time you'll have to pay is not till May 27. So we've got time to map out a plan as to how it's going to impact you and what you should be doing in your specific situation. And unfortunately, the answer is it's going to be different for everyone. So it does take a bit of time to really think it through and map it out.
And we don't even have actual legislation yet either. So the final legislation that gets royal assent could be different to what we're working towards.
And exactly. So at the moment, we're still asking clients to just keep calm and talking to them about some of the plans and ideas that we've got for them. But we're just sort of saying, don't rush out and make any decisions, because until we see that final legislation, we don't know what's going to be right. And I mean, we are still holding out hope that there is some backtracking in that final legislation. It's slim, but there's certainly plenty of lobbying out there, and there's plenty of talk about it. And obviously, If you've been following the paper, you've probably seen people already making some very big mistakes around this, which has made the government realise that it is actually a concern.
So am I correct in saying don't just pull everything out of superannuation before 30 June?
Yeah, definitely don't pull it out of superannuation before 30 June. Most of the clients that are impacted, you know, super is still probably their best tax bracket that they can get. So let's really understand how it's going to impact.
And I know some of the conversations we've had have led to thinking about it a bit more on a long-term basis, especially if they're getting a bit older and maybe they're the last member of the fund, and I think you call it death duty or death tax sort of starts to come in.
Yeah, we call it death benefits tax. And for me, that's actually where this part of the legislation, if you add on to it the death benefit tax rules that have been in place forever, it's where it becomes a bit unfair for clients. So I guess in the past we used to talk about strategies around trying to get all your money out of super before you pass away, so you don't have that death benefits tax for the next generation. Now we're probably having some of those conversations a little bit earlier, because if you're going to be paying that extra 15% already, and then there is a likelihood that your beneficiary is going to pay 15 or 17%, including the Medicare levy, maybe we start to bring some of these transactions forward. So we are sort of considering and talking to people about restructuring their ownership of assets, or even that, you know, the discussions around when it is time to gift to the next generation. A lot of people are really focused on that, especially with property prices the way they
We're talking about that a lot more at the moment, aren't we? And I suppose the other impact it has on longer term sort of entity structures, that maybe super might be less appealing to put an investment in, like a property or something or other, than say a company structure that's taxed at 30% anyway.
Yeah, I guess in a lot of ways, and things that are coming up more is this sort of legacy style investment for people who want to leave specific assets for the next generation to continue to generate that income and growth for those people. We're finding more and more super's not the right place to do that, and having a different structure such as an investment company is a great alternative to allow it to easily pass on to that next generation and not pay huge amounts of tax.
And that compounding effect of lower tax rates in the company structure.
Yeah, exactly. By still being able to get money out to the right people along the way. So just keep in mind that there is other ways and other alternatives, and that, you know, maybe what we've done in the past and recommended in the past will change. But it doesn't mean that your situation has to change dramatically at any time in the near future.
Yep. Okay, so obviously this is very much a watching brief. We've got to get the legislation, but we wanted to get a few tips out there so we didn't have people sort of getting a little bit carried away and doing anything that might actually cause you some harm in the end. Thank you very much, Megan. There's lots more to talk about this over the coming months and probably years, to be completely honest. So if you do have any questions, please reach out to Megan direct or to your usual contact here at Business Depot. And if you'd like to stay in the loop, please subscribe at businessdepot.com.au or on LinkedIn.